Hey traders, welcome to Charts and Coffee. Hope everyone is having a great morning. We had the CPI released at 8:30, and you can see the subsequent move to the upside. Interestingly enough, I wouldn't say the CPI read if you're just looking at the data, which I don't suggest. Look at the price action, look at the Fed fund futures, target rate, probabilities. But if you take a look at the data, and you see the way in which the CPI triggered prices higher, if we look at the previous number, we can see the CPI was cooler, right? And then we can process that one of two ways. Either the Federal Reserve, their plans are working and inflation's cooling, which, by the way, there have been signs that inflation has peaked some time back. It just may not be cooling at the pace that they would like. But ultimately, it is doing what they want. So then the thought is, well, they don't need to keep hiking. And we keep all these ideas in mind, but ultimately, what's the most important thing is just going back to a rate of change understanding of the data and saying, all right, are we seeing a lower probability for rate hikes after the one that we are most definitely going to get at the end of this month, July 26th? So yes, rate hike come July 26th, 2:01 p.m. Eastern, we're going to be at that 5.25 to 5.5. Then we move out a little further, and now the question is, are we going to see another hike? And there's been conversation of that on and off for quite a few months. September, right now, that's a big cup of nope. That's a pause, right? That's a hold. November, again, as long as the most prominent column is a 5.25 to 5.5, that reflects the 25 basis point or quarter point hike that we will get this month. And then every month after that has 5.25 to 5.5 is a hold. So hold in November, and for the most part, hold in December. Now, it doesn't mean that there's not a possibility for a cut. It doesn't mean that there's not a possibility for another hike, but the most likely probability, right, is the hold. And notice in December, there's a 23.4% compared to 57% and change expectation for a quarter point hike, but then there's a 15.8% expectation for a cut. So we just really don't know if we're going to go dovish or even if we're going to continue to be hawkish. Pause seems to be where we're at, and pause needs to precede the pivot. So typically what we're going to have is either some sort of extreme situation where the Federal Reserve says, oh my gosh, we've gone too far and we need to change monetary policy on a dime. That's that dramatic pivot that the Fed has done before. With Powell at the helm, we've seen that before. Or we're just going to have a nice pause. The Federal Reserve can start to prepare for their eventual rate cuts, and those will come likely next year, right? We can start to look at the Fed fund futures and say, all right, what are we expecting? Yeah, that's sometime probably, maybe not Q1, maybe towards the end of Q1, maybe Q2. Although that's way far out, that's what we've got. And every single inflation metric is going to inch us closer and closer to more clarity as far as what the Federal Reserve is most likely to do. That's why that information is valuable, gang. That's why that information is important, not to just think about as a trading opportunity, but also as an opportunity to understand rate of change, macroeconomic. All right, so that was my breakdown of the morning. That is what we're looking at. So let's jump into the questions. And as always, if you have a symbol you're looking at, what time frame? Are you bullish? Are you bearish? Are you looking for an entry? Are you looking for a target? Let me know. We'll dive into the charts and see what we have. All right, so let's get to it. First up, Megawatt asks, after the NQ rebalancing, when do I think it could continue the uptrend? I don't think the uptrend's been disturbed. You're right, as far as when the continuation would occur. So remember, gang, and this is something that pops up from time to time. I addressed this pretty specifically in the current This Week in the Market newsletter. So in TWM, I kind of went after one of those sacred cows, and it's really a dual-pronged topic of equal balanced or equal weighted indices. Garbage unless you're an investor. There's no reason to focus on those for a trader because it's not the way the markets are truly weighted. It's like running around thinking 13 ounces is a pound, right? It might be a measurement. It's completely random and it's completely wrong. Yeah. And the other part of it is, in that same vein, market breadth is absolutely useless. Why? Because we live in a high concentration world. And I think Megawatt, you bring that up because indirectly, why are they rebalancing? Because they acknowledge that the NASDAQ is weighted with 55% and just 8 stocks, right? The seven magnificent, right, companies, 8 stocks. If you want to add a ninth with NVIDIA, so much concentration. By the way, even after the rebalancing, there's going to be a ton of concentration. All right. So if we're going from 55% to about 40, that's still an extreme amount of weighting in 8 or 9 stocks. It's just not as much as it was. So I don't in any way feel that the rebalancing is going to do much more than a lot of volatility. I don't believe we're seeing any significant disruption of the overall move higher. So really what I'm trying to do is just debunk certain things that don't serve us as traders. And a lot of folks want to fight this, right? Because it just sounds, I don't know, maybe it sounds sophisticated to come up with some fancy variation of the indices. But why would we do that? Because we're not trading a variation of the NASDAQ that is anything other than the way that it truly is comprised, right? So what we're seeing here is that rebalancing, not sort of this idea that it's going to not that it's no longer going to be high concentration weighted. So yeah, there's no reason to think it won't continue for those reasons, right? Equal balanced indices or some sort of cutesy manipulated made up index of random weightings, useless, and market breadth, utterly useless. Why? Because so far the NASDAQ and the S&P have been grinding higher on tech alone. Why? Because tech is high concentration weighted in the NASDAQ, obviously, and in the S&P. The S&P hasn't needed healthcare. The S&P really even hasn't needed financials. But if we get more involvement, great, right? That's fantastic. More people in the party. Who doesn't want that? But you don't need it. Right? You don't need it. So keep that in mind, gang, because I'm still seeing a lot of that running around and it absolutely is nonsensical. It's a cute conversation, but it's not going to get us where we want to go with our trading. All right. So next up, Danny asked, do I typically expect a mirroring of the CPI? Yeah, I will. Yeah, I will actually, because if you take a look, kind of going back to Megawatt's question about the resumption of the uptrend, it hardly was nudged daily time frame wise, and coming into the hot zone today, coming into the hot zone this morning, we already had an uptrend. So I would expect that echo, as I like to call it, Danny. Yes, I would expect that echo in terms of now we have equity traders able to express an opinion about the hot zone at 9:30 an hour after. I would see that. However, one thing to keep in mind, Monday morning after the bell and Tuesday morning after the bell, we continue to see a little bit of the unwind in those major stocks that are going to be reduced in weighting in the NASDAQ. So I'm not really sure. It's going to be interesting. Have we seen enough of that shakeout already Monday and Tuesday where it looks like pre-market the NASDAQ is strong, and then through either the clearing or even clear through initial balance, the first 30 to 60 minutes of the morning, we start to see the movement back down? I'm not sure that we may not see something like that, right? That's going to be a tricky thing. Let's keep in mind it probably will be worth waiting about 15 minutes after the bell to see if the NASDAQ is going to have weakness in Apple, Microsoft, Amazon, Tesla, Meta, Google's, and NVIDIA, right? If it doesn't look that way, then yeah, the echo of the 8:30 hot zone's in full effect. That's the way that I'm going to look at it. All right. Next up is Alex says, I have to follow up on yesterday's discussion. The S&P is a little puppy that the NASDAQ takes out for a walk, or sometimes the Dow, right? And by the way, Alex, thank you. That goes right back to waiting, right? That goes right back to why does the S&P move with the NASDAQ most of the time? Because of the XLK weighting, because of Apple and Microsoft. Yeah, absolutely. And then sometimes it will move with the Dow. And that's because usually you have a tag team of strength or weakness in financials and healthcare. So those are the two common sectors that the S&P has with the Dow, right? And the Dow, also high concentration weighted, it's a financials index, gang. It's a financials index, followed by tech, followed by healthcare. And you might say it's the Dow Industrial Average. Not anymore, right? When you look at transports, when you look at industrials, it's way down the list, way down the list. All right. Yeah, great stuff. I think you all are getting this, right? When I see the kind of questions and the understanding of high concentration weighting, I love it because, gang, I'll tell you, not 2 in 10 traders get it. Everyone else is busy trying to, figure out a cutesy way to reorganize the indices, or they're looking at equal weighted gosh, please just put that where it belongs, in the garbage can. All right, next up, NVIDIA. Yeah, hey there, Oscar. So if I take a look at NVIDIA daily time frame, I would like to be a buyer. Market structure above all. It's maintained the strength after the gap, although, clearly not accelerating. But if we wait for a little bit of weakness into the volatility zone of the daily price movement range, we're in good shape. So today, I don't think we're anywhere near that at the moment, unfortunately. But if we get that weakness like we saw on the 10th, right? So this would have been Monday. We get that weakness into the gray zone like this, buyable. Yes, it would be buyable. So I'm waiting for a pullback into the volatility zone. All right. Waiting for that pullback into the volatility zone. So great question. Where can I find the weighting? Love this question. Yeah, there's a couple sacred cows in the market that just need to go away and live their happy life elsewhere. And one of them is, yeah, exactly. Let's dive into why I'm so adamant about this. Take a look. Where can we find the weighting? Head on over to, I like etfdb.com. This is a site right here, etfdb.com. And the magnifying glass, these are things that I teach in the Sector Secrets Mastery Gang. So we're always coming at the market from the perspective of watch list is more important than strategy, or secret squiggles, which is my nickname for indicators. And watch list has to be built based on relative outperformance. The relative part of relative outperformance comes from acknowledging that we are trading high concentration weighted indices and sectors. So here's the NASDAQ. Now, this is not the way the NASDAQ is going to look this Friday. The announcement of what percentages to which we're going to drop those top 8 stocks. I've been saying 9, throw the NVIDIA in there, where we're going to drop those stocks in terms of weighting. Collectively, it should be dropping to about 40%, which is still an immense amount of weighting for a 100 stock index. So it won't look like this come Friday, but this is what high concentration weighting looks like, gang. Disproportionately, think about this. There's 100 stocks in the NASDAQ 100. 2 of them make up 25% of the weighting. That's Microsoft and Apple. You see that? That's why I say high concentration weighting is so often ignored, and why it makes no sense to accept the markets for what they are, which is a very small number of stocks having a disproportionate influence. And it's not just NASDAQ alone, right? What if we go into, let's look at the Dow. You might say, well, Ron, is this a NASDAQ only phenomena? Oh, heck no, right? Dow 30. Take a look. 30 stocks, and just look at the top 5, right? Take a look at the top 5 or the top 6, so 1/5 of the Dow, and look at the weighting, right? So if you think about, oh, wait a minute, 9%, 6.5%, 6%, 6%, right? By the time you add up the collective weighting of just the top 5 or 6 names, once again, disproportionate weighting in a small group. And all 3 of the major indices are this way. XLF, XLV, XLK, XLC. These are all the important weighted sectors in the indices. They're all this way, right? They're all this way. So if I just crack open XLC, the communication services, this is Google and Meta, or I should say Meta and Google in that order. And again, as long as you know the weightings, you're trading in the real world, right? The minute we start to vary from this, we're not trading in the real world at all. And this is why I say, gang, market breadth does not matter. Yeah, it does not. Because look, do I care if Charter participates with the XLC. Meta is 24.5%. No, we need basically Meta, Goog, and Google. And if that moves, XLC will move, right? Really doesn't matter if Take Two moves. So market breadth would be, hey, we need all of these stocks to move higher. We don't, right? That just doesn't play out in the math. So I hope that makes sense. Now, there are some sectors and indices that are not this way. The Russell 2000 is not high concentration weighted. The KRE is not high concentration weighted. So there are certain corners of the market where we don't have this high concentration weighting, and that's in regional banks, which tethers to the Russell, right? So those are two places where no, we don't have a very small number of stocks having that disproportionate influence. So yeah, Jay, in terms of bank earnings for KRE, well, the big banks are coming out. So Jay, I would say track that to XLF. So the direct impact is going to be on the XLF, right? KRE is going to be tricky because as we go into the latter part of the year, not in any way do I want to start to fear monger, because where are all those folks calling for the, apocalyptic moves to the downside, right? Let's not call where things are going to be in 6 months. Let's take each data point as it comes along. That's trading. So the rest of it's clickbait. So if we're talking about bank earnings, that's going to land in the financials. My concern with XLF is, number one, big banks are not necessarily going to reflect the health or the direction of regional banks, right? And regional banks have a disproportionate exposure to that. And it's going to come, gang. How it's going to shake out, I don't know. But we have that coming commercial real estate debt that needs to be refinanced. And with occupancy rates as low as they are and rates as high as they are, there's a lot of speculation. And I do think, rightly so, that this could be kind of ugly. And you'll see that KRE is having a hard time getting out of its own way, unlike the XLF. Let me show you that chart. Unlike the XLF, which is starting to move higher. JP Morgan looks pretty darn good. Number 2 weighted stock in this high concentration weighted sector in an uptrend, right? So I would say, focus on XLF for the end of the week. Be careful with the regional bank, because remember, there's no disproportionate weighting any one bank has in a big way over the others in that sector. So XLF for me. Yeah. All right. Very cool. What else do we have here? Oh, you know what? Let me do this. So this is KRE, right? Not trending, right? So if I'm going to play any kind of expectation out of earnings, I'm going to presume that the market is discounting expectations going into the hot zone. So if we're already seeing XLF break the 200, if we're seeing XLF through July turn into an uptrend, look, we know earnings are coming. So this is a concerted effort from traders saying, yeah, I know earnings are coming, and I know the Fed's going to hike again at the end of the month, but I want to buy financials. And if there is some rotation happening, if there is a sector that's benefiting from just general risk appetite, healthcare is not benefiting yet, but XLF is. And that's actually really helping the S&P, because as long as tech remains strong, S&P benefits. And when financials start participating, S&P is firing on more of those cylinders, those sectors that are highly concentration weighted within it. So we're in a really interesting and bullish time, gang. I know a lot of folks say, hey, have we gone too far? That is only the concern for traders who are buying new highs. It really is. If you're way out on the edge of a limb, you've bought a new high. If we're in a very strong trend, we can sort of get away with that. But if we want to embrace mean reversions, retracements, which are two different things. If we want to embrace it, if we want to embrace pullbacks, if we want to embrace buying at support, not buying as we break through resistance, we're in a less vulnerable spot to be concerned about, oh, have we gone too far? Because remember, traders buying at newer highs need even more people coming behind them to continue to buy at higher highs. And yes, while exhaustion trading does need buyers, right? What we're actually trying to take advantage of is the psychology of a sale. Who doesn't like a sale? We're living through 2 days of Prime, right? With Amazon, there's something about a sale that does elicit a much more predictable reaction from humans, right? We like things that are on sale. So if we can find an uptrend that's pulling back, a lot of times that blue light special thinking, that 2 days of Amazon Prime thinking, kicks into gear. So don't underestimate that sort of very typical social behavior around that. But that's my 2 cents on trading the trend there. All right, gang. As always, thank you so much for being a part of Charts and Coffee. And I will see you tomorrow. Same time, same station. Be good to each other.